All right, so I got back into options trading and I started by using binary options. A binary option is a play on a catalyst that's coming up, and I chose to use earnings since we're in the middle of earnings season. And what it means is that if I'm right, then I have an option that pays out, and if I'm wrong, the option turns to zero pretty much the next day after earnings reports. In other words, I'm going to come out and say that the company is going to have good earnings, and therefore the stock price will go up. If they have bad earnings and disappoint, the stock price will go down and the option spread will expire completely worthless. As you can see, the worksheet has changed dramatically since the last video. As I was going through the trades, I realized there was a lot more information that I wanted to have at my fingertips that would be automatically calculated. In addition to what we had before, I've added a section here for the plan price. What this means is when I do my research, that's what the option cost at that time. That way I can do some calculations and then figure out what it's going to be when I actually buy it. I didn't buy this one, so I left the plan price in place. That way you could see what the maximum profit would have been, what the max profit and percentage would have been, and then what the actual profit and loss and percentages would have been. Then I added two additional columns, one for what the stock price was when I opened the trade and another for what the stock price was when the options expired. That way I could see what the actual results were of whatever I estimated. And then I added two additional columns, a break even and a full profit. And what this tells me is the percentage that I need the stock price to move in order to reach break even. And then the second column calculates how much the stock price needs to move for me to have full profit in that spread. As I said before, I wasn't planning on any of these really paying out because I was limiting how much money they were going to cost in such a way that it needed to be extreme moves. In other words, I would look at the past and see how far one of these positions moved typically, and then see how far they could move, and then buy a spread that was probably closer to the far out move. As you can see with Apple, I bought the 177.50, 175 put spreads. This would have been an extreme move about 6 or 7%. And what ended up happening is after I did buy the option, it did sell off. However, at the end of the expiration, Apple only sold off 3.25%. So it wasn't even close to what I needed it to be. It would have had to sell another 4.55% in order for me to be at break even, and another 5.84% for me to have full profit. So that option expired worthless, and I lost $10. No big deal. But it's important for me in the future to remember that instead of having a spread of $2.50, what I should have done was to decrease the amount of the spread. In other words, I would have limited the amount of profit I had, but I could have raised how much it would need to sell off, so that I could have bought an option spread that was a 3% sell-off instead of an option spread that was closer to 10. The AMD put spreads never filled for me. I didn't want to pay $51 to cover it, and that ended up being a good decision because it only sold off 0.6% by the time of expiration. In other words, that would have expired completely worthless. Amazon ended up reporting good earnings, which meant that it blew out the put spread. There's no way this would have been profitable, and pretty much the day after, the put spreads went to zero. So that was another $12 gone. Boeing ended up beating expectations, so the stock price did pop after earnings, even though they didn't give any guidance at all because of the 737 MAX 9 issue that's currently affecting them. As a result, those put spreads expired worthless. I did get lucky with the Alphabet trade. I had put spreads on the 142, 141 strike prices. However, you can see that as of expiration, although Google did sell off a lot, it actually expired above my long strike. So if I hadn't sold these put spreads when I did, they would have expired worthless. Alphabet did beat on the earnings expectations. However, the forward guidance they gave wasn't good. And in addition to that, they refused to break out AI into its own product category. They also announced that they'd be increasing their capital expenditures. In other words, they're going to be spending more money on research into AI this year. None of that's really good news for shareholders. From where it closed before earnings to its low on Friday, it did sell off nearly 10%. And it sold off so much that it hit a low down here of $136.50. But as you can see, by the close of the day on Friday, it closed at $142.38. In order for my put spreads to be profitable at all, it needs to close under $142 plus the cost of the puts, which was 10 cents, which means it would have needed to close at 141.90 or lower for me to be at break even or profitable. But what I did is after they reported earnings and came down and dropped, I gave it one more day. This was Thursday when Apple, Meta, and Amazon were all reporting after the bell. And I was concerned that if Amazon or Meta reported good earnings, that what would end up happening was Alphabet would rise in sympathy. So I ended up selling the put spreads on that day. As a result, I received $43.86 in profit on a trade that cost me $13.06. In other words, I made a gain of 335.83% on this trade. However, I also bought the call spreads, and what I did was plan for an extreme move in either direction. Now, if Alphabet hadn't moved as much as it had, both of these option spreads would have expired worthless. But because Alphabet sold off so much, the profit I made off of the put spreads doubled what it cost for both the call option spreads and the put spreads. In other words, I doubled my money, even though half of the trade expired worthless. I did buy put spreads on Meta, and as you can see, it had such a blowout quarter that it jumped 20.57%. When we're talking about put spreads, we want it to move down. So what this column is calculating is how far below where the option opened is the stock price. If we go down and we look at the call option spreads, you can see that it's the opposite. Since we want the price to move up, if it moves down from where we opened the trade, it turns the cells red. But if it moves up, it turns the cells green. Now here's the worst part of what happened when I was going into this particular week. I have no problem losing money on trades, but I absolutely hate it when I miss out on gains. And I had been eyeing the Meta 440, 445 put spreads, which would have cost me $39.08. There were two reasons that I didn't buy those put spreads. For one, I was trying to keep all of these spreads under $20. And second, that would have represented a jump in Meta's stock price of more than 10% after earnings, which is incredibly rare. However, if you'd been paying attention, Meta reported such a blowout quarter and announced that it was going to have a dividend yield that the stock price jumped 20%. This means that this call spread, which would have cost me $39, would have actually paid out the full $500 at expiration. In other words, I would have made $460.92, 1,179% in profit, and it would have easily paid for all the options that I bought. And what this means is in the future, I may have to increase my budget for these options purchases. This entire week showed me that I can't bet on these moves being as dramatic as they are. So I either need to limit the amount of the spread, in other words, limit the amount of profit that I can make, or I need to increase the amount of money that I'm spending so that I can move these spreads closer to the stock price. I can't be betting on 10% or even 5% moves after earnings. If I want these earnings plays to pay out, I'm going to have to be more careful next time. If you have any interest in receiving this spreadsheet, let me know in the comments. I don't know if it would help anybody for me to release it with the data that's in it, or you could manipulate it on your own. But if you are interested, please let me know. As we move on from here, I do have a number of different call spread and put spread plays that I'm going to execute in the following week. So next week, I'll have even more to report back to you on how badly I'm doing trading options.